I'm Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, JPMorgan's record year. We break down how tech helped push the bank to its most profitable year ever. Plus, Case's crystal ball. We'll look at one of the internet's pioneers, what he sees for tech in the decade to come. And hacking Ukraine. In the midst of an impeachment investigation into President Trump, Russian hackers went after the company at the heart of it all. But first, to our top story, and that is all about bank earnings. They're in full swing, and JPMorgan is setting records. Tuesday posted the best year for any U.S. bank in history. Shares jumped nearly 20% in the fourth quarter, fueled by a rebound in trading, especially in fixed income. Joining us to discuss in New York, it is Bloomberg's Sonali Basak. So, Sonali, when you take a look at the fixed income trading, really the numbers that came out, it seemed like humans at least stand another chance against the robots that had been threatening so much of that trading business.
They sure do, Taylor. But even though there are humans that are involved in this business, remember JPMorgan, among other banks, are working very hard to make these businesses much more electronic. And if you look at these banks, actually almost every part of these banks are being transformed by technology, except the M&A rainmakers, where you really need the relationships to make a difference. But even JPMorgan is making strides in traditional investment banking businesses where other people are not. And so if you talk to anyone in JPMorgan, the CFO, Jen Pipsack, definitely says that they're just at the early innings in terms of what technology could do for them. And that's with a nearly annual $12 billion spend on technology.
And when you take a look at how they are shifting, if we're only in the early innings of that transformation from technology, what do they do with all that retail physical presence?
They love their retail physical presence because some of the more complex things you do in wealth management, or if you go to a branch network and need a certain type of loan, JPMorgan, Bank of America still believe that those branch networks are necessary. Citigroup believes so as well. But that doesn't mean you can't supplement the digital with the branch networks. And so Citigroup, for example, this morning they were explaining that their digital deposits have risen to $6 billion. Just last year. That's sixfold. And so they're really making progress on both fronts here.
Any thoughts on how they transform to repurpose that retail space? Like you said, a lot of our banking is now done online, but millennials, we want to make sure that we can at least see a branch if anything goes wrong. How do they repurpose that retail space to accommodate the technology?
Well, check it out. First of all, they have to make these places more welcoming and do a lot with less space because these retail spaces can be expensive. And it's something they can do to really appeal to a broader audience. We had Citigroup this morning talking about their relationship with Google and to expect more products alongside Google in the first or second quarter of this year. And remember, Goldman Sachs, which reports tomorrow morning, the CEO has already started talking about the Marcus app, which rolled out much more quietly than their relationship with Apple. But they're very excited about the fact that now you can do many more banking services on a mobile app.
So speaking of, what did we learn about Zelle and some other peer-to-peer banking mobile initiatives?
Very simple, just that they're steadily growing. It supplements the larger banking story. The big banks have been pretty hesitant to do what we saw with Visa, for example, that just go out and acquire another big company. We've seen Goldman and whatnot make acquisitions at the margins, but generally we see them investing to build their own products and then do a lot of partnerships on the side. And so that seems to be the parting line in terms of how they're interacting with the technology industry.
You mentioned a lot of their tech spend. What do we know about how they're spending to invest in that electronic trading and some of the other robotics and AI, perhaps?
So I was saying before that it's just at the beginning. When you look at the trading businesses in particular, in the equities trading business, there has been a lot of progress across all of Wall Street. But the fixed income business, we're really just at the early innings here on how much JPMorgan and all the other banks can do. And this has been about a one-year story here where people are really making a big difference in that world. If you look at MarketAxess, they're one firm that focuses on this world, and they've really blown out of the water last year. And so there definitely are strides to make there, and people are benefiting from the investments they're making there.
Well, Shanali, don't go anywhere because we're moving on to our next story, and I want to include you in this conversation as well. That has to do with the big deal now surrounding fintech. Visa has agreed to pay $5.3 billion for Plaid, a fintech company that connects popular apps like Venmo to customer data in the banking system. The price is double Plaid's valuation in a 2018 funding round. Let's bring in Bloomberg Intelligence's senior analyst for fintech, Julie Shariel, to join us in this conversation. Julie, point blank, what does Plaid do for Visa?
So Plaid has 2,600 fintech customers, right? And it has the big ones. It has Venmo, as you mentioned, Acorns, it has Coinbase, right? So it gives Visa these customers to sell into. Plaid also really has been a US-based company. So Visa is in a great position to add fintech customers internationally with the Plaid services. On top of that, a little bit longer term, Visa sees as an opportunity to sell payment services, payment capability into fintechs. What that will mean is more payment transactions going across the Visa global network.
Shanali, I want to bring you back in here. And earlier we had NEA general partner and a Plaid investor, Rick Yang, talk about traditional financial institutions getting into more of this space. Take a listen.
You have a lot of traditional financial institutions that are starting to think about what is our software strategy? How do we stay relevant? How do we continue growing like a software company? And then you have a lot of software companies that are realizing the benefits of fintech to the consumer, thinking about offering more financial type services. And with infrastructure like Plaid, it becomes much easier to bundle that into software. So if you think about what Visa did and how they talked about their rationale for acquiring Plaid, it was really about growth and it was about expanding the TAM.
Shanali, what do you make of those comments?
It's pretty amazing because if you look at some of the big stories of last year, WeWork, Peloton, and some of the non-traditional technology companies trying to command technology multiples, they had a somewhat hard time, and the software companies are really the ones that won out. People expect a lot of mergers and acquisitions to happen in the software space, and so it seems like we have a pretty perfect marriage here where the software people found the financial industry, and the financial industry found a real need for the software people that they have just been burning for. And otherwise, they would have to pay up so much to be hiring these people themselves. And so the partnership's been working quite well. I don't know how many exits we can see that are this big, but remember, there are a lot of really interesting fintech companies out there that have ballooning valuations, including Stripe, which is the most valuable startup in America right now.
Julie, an analyst over at Jefferies, came out with a note and said that Visa had traditionally lagged MasterCard when it comes to showing its value to fintech customers. How does this now change the game again for Visa relative to some of its other competitors?
Yeah, there's a bit of a lag, but I do think that this helps Visa to catch up and pretty much levels the playing field. You know, what I think this really is showing us is that these big companies with deep pockets are able to throw money at the problem, at the issue. When they need a capability, when they feel the time is right, they're able to go and pick up these companies. Essentially, the revenue of a company like a Plaid, as attractive and as fast growing as it is practically a rounding error, right, for the revenue of Visa. So as these companies need this technology and they feel that the time is ripe, they're able to throw their big dollars at them.
Well, this also addresses the theme of digital wallets. What types of other transactions have we seen from Visa as they look to enhance their digital wallet, if you will?
Yeah, so, you know, when the digital wallets first came out, everyone was writing the obituaries of Visa and MasterCard, right? But the card brands were pretty smart to recognize that people didn't necessarily want to get rid of their credit or debit cards, right? They wanted to be able to use them, but now they could use them on mobile in a much easier way, right? So Visa allowed its credentials to be added to a wallet so that people can keep using the accounts that they always wanted to use. And that's what happened. At the same time, it made it easier for the merchants to accept digital wallets because they were already connected, most of them, to the Visa network. And now they could easily continue to process payments now using wallets. So the threat really wasn't there. It turned into an opportunity. And right now, Visa is partners with all the major wallets in the US, in Europe, in India, in China.
Thank you to Bloomberg's Shanali Bossack and Julie Shariel. Appreciate it. And Rachel Holt, one of the first employees at Uber who rose to become one of the most powerful women at the company, is leaving to start a venture capital firm. Holt is teaming up with Dana Grayson, a venture capitalist from New Enterprise Associates, to create the new firm, Construct Capital. Both women announced the moves on Twitter, but didn't offer details such as the target fund size. Holt led the development of new mobility projects at Uber, such as electric bicycles and scooter rentals. And coming up, AOL co-founder and current chairman and CEO of Revolution, Steve Case. His insight on the top tech stories, as well as new startups and innovation. All of that next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. British Prime Minister Boris Johnson is hinting that he will not ban Huawei from the country's 5G networks. The U.S. has been pressuring the U.K. to ban the Chinese company for national security reasons. Johnson tells the BBC if people oppose one supplier of 5G technology, they have to come up with an alternative. And whether it be Huawei or Apple, there is no shortage of tech-related news that is shaping the industry. Among the big themes to emerge, customer data and privacy, antitrust, as well as U.S. trade. For more, I'm joined by Steve Case, AOL co-founder and current chairman and CEO of Revolution. Steve, it's great to have you. The first story that I wanted to get some of your thoughts on are about Apple and FBI. This is a little bit of a complicated story, as you know, a December 6th terror attack on a Florida Navy base. The FBI wants the data from Apple. Apple's a little bit hesitant to turn the data over. Generally speaking, where do you see tech working with government officials, working with the FBI to help, but also be worried as well about protecting people's data?
I think you framed it perfectly as a balance between individuals and society in terms of what technology enables, which is positive, obviously, in many different aspects of our lives, but also some of the risk. This was an issue 5 years ago, actually, with Apple also. There was a case with a problem in San Bernardino, and law enforcement wanted to open up the phone. That went back and forth. There's a new case now. This is just a trend. We'll see more of these cases in the years to come as technology, and particularly the internet, becomes so embedded in everyday life and so fundamental that it's going to deal with a lot of issues in terms of what it enables on the positive side and how do you make sure society is protected from bad things happening.
You know, some of the arguments from big tech is if we create backdoors or loopholes, it invites bad actors as well to come in. Is that a rational argument?
No, it's a fair argument. The problem with these things is they are super complicated, and you really have to dig into the details. I don't know all the details, for example, with this recent case in Florida. The law enforcement, Apple obviously have a lot more insights than any of us would have. But these are not simple issues. It really requires engagement. That's one of the things I hope will happen more in the next 10 years, and having more engagement between the innovators, whether it be in Silicon Valley and other places, and the policymakers, because now we're going into an era where it is so fundamental. Getting the balance right here is really tricky. And of course, privacy is important. Of course, it makes sense for Apple to protect its privacy of its users. That's one of the ways they're differentiating their company versus other companies. But it's also, of course, reasonable that law enforcement has the tools to protect us as a society. So they're really tricky, and you really got to get into the details. But it's only going to happen when there is a partnership, a dialogue.
Mm-hmm. Well, we are waiting phase one, at least perhaps tomorrow, of the signing of the U.S.-China trade fight, and hoping to get a little bit of a resolution. As you take a look at phase one and really going out further, and especially as a tech entrepreneur, do you feel that we got enough concessions from China, both with IP theft and some of those forced tech transfers?
Well, the tech transfer issue is probably the most fundamental and in some ways the trickiest. Like China actually agreed, I think it was 19 years ago, as part of a WTO agreement, to not require U.S. companies to transfer technology to be able to compete in China. But that was not really enforced. So it's partly what gets announced this week. I think having some kind of truce, having some kind of settlement here so people can move forward and there's clarity. Everybody knows the rules of the road in terms of how this is going to work. I think that's helpful, a step in the right direction. But it really comes down to the nitty-gritty and the execution of it. I think the broader issue from a strategic standpoint, even a global standpoint, is obviously for decades we've been focused on the internet as a global phenomenon, even the notion of the World Wide Web. But we are seeing, particularly in China, but also more broadly in Asia, sort of a splintering of the internet. Some even called it the splinter net. And the internet's not going to necessarily be as global and integrated as it has been for the last several decades. So there are a lot of issues around policy. I think that's going to be one of the big trends. It's not so much about what you can innovate, which has been true for many decades in the tech industry, but how that is connected into everyday life and dealing with some of the policymakers in a constructive way, making sure both sides understand each other is going to be critical to getting these issues right.
Well, and Steve, I'm just curious, given all of your experience, how do you operate a company in China? How do you operate an internet service, given effectively you're reporting to Beijing when you do business over there?
No, it is tricky. And Google, as an example, decided not to do that. They didn't want to have to make some of the compromise necessary to be in China. But then after being out of China for many years, they decided a few years ago to go back and make some of those compromises. When I was running AOL over 20 years ago, we had a similar dilemma with some of our services. We actually decided not to continue to compete with some things like instant messaging because we were worried about some of the restrictions, including around censorship. So there's a balancing in terms of building your company, trying to build revenues, trying to serve more customers, trying to create more shareholder value, but also trying to figure out sort of your broader responsibilities in society. Every company has to make their own decision, but it's certainly getting more difficult than it was years ago.
Steve Case, Revolution Chairman and CEO, is going to be staying with us because up next, how he thinks technology will shape the next decade. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Revolution Chairman and CEO, as well as AOL co-founder Steve Case, still with us from Washington. Steve, you've been traveling the U.S. You're looking at startups and innovation hubs outside Silicon Valley. You announced 5 new destinations to your Revolution road trip in April. They're Wichita, Oklahoma City, Tulsa, Northwest Arkansas, and St. Louis. Why those cities?
Well, this is our 9th road trip we've done. So far, we visited 43 cities all around the country to shine a spotlight on these rising cities that are becoming stronger startup cities and some of the entrepreneurs there that are building really interesting companies that are trying to break out. Obviously, Silicon Valley is terrific and will continue to be a great center of innovation. But right now, it's crazy that essentially all the venture capital goes to entrepreneurs there and other places like New York and Boston. Last year, 75% of venture capital went to just 3 states. And a lot of their states, whether it be Kansas or Oklahoma or Ohio or Michigan or other states, all get less than 1%. So we're trying to level the playing field, get more venture capital to more entrepreneurs so they can create more jobs in more parts of the community. We can have more of a inclusive innovation economy where everybody feels like they have a stake in the future and can be part of the future as opposed to just a few entrepreneurs in a few places. It's exciting to see what's happening in these cities. There have been a number of breakout successes with our Rise of the Rest the seed fund. We've now backed over 100 companies in over 70 cities, over 30 states, and we're really just getting started. It's exciting to see what's happening out in the rest of the country, not just on the coast.
Well, it wouldn't be a good interview with an entrepreneur if we didn't get some of your top 10 predictions for the next decade as we sort of wrap up the last decade. Reading through your blog, one thing that really stuck out to me was the rise of health and wellness within the startups. I wonder, though, as this increasingly becomes a bigger and bigger theme, how much of this appears to be overvalued, given there has been so much attention already on health, on wearables?
Well, I think you ain't seen nothing yet. Healthcare is 1/6 of the economy, one of the most fundamental aspects, obviously, of our everyday lives, and it's really ripe for disruption. A lot of the focus in the last 5 or 10 years has been on the wellness side of things like wearables, Fitbit, and others, because that's a consumer decides, a consumer pays decision. It's a lot easier to go to market. The real focus in the next 10 years is the core of the healthcare system, what really is a sick care system, and there are a lot of companies doing really interesting things. One we backed through Revolution in Chicago, a company called Tempus is using big data, machine learning, AI to diagnose cancer much more effectively, much more precisely, so people know exactly what they're dealing with, and there can be much more of a personalized approach to the diagnosis and then the treatment. So you can see a lot more of that, the convergence of technology to really provide better health care more conveniently with better outcomes and at lower cost.
Another one of your big predictions was more tech backlash. I think the problem here is there isn't enough trust really between the consumers and then the owners of that data as well. How do you get more trust so that there isn't that big backlash that we've really started to see in the last few years?
Yeah, I think there's two areas to look at. One is sort of the consumer side of things. Consumers still love their technology, the iPhones or Netflix or many other things, but they're starting to get a little bit concerned in terms of what these companies are doing with their data and other kinds of things. They're a little concerned about even the elections because of some of the things happening around Facebook. So they're getting a little more anxious that maybe what they thought was all positive, maybe there's some negative. And as a result, not surprisingly, the policymakers, whether it be here in D.C. and Congress or other places, are saying, this technology does enable a lot of great things to happen, but how do we strike the right balance in terms of managing this? And I think you'll see in the short run, because of this backlash, in terms of including a regulatory backlash, probably a look on the antitrust side. Should some of these big companies, Facebook or Google or others, get broken up? That may or may not happen, but at minimum, I think these companies will be a little more careful about making any new big acquisitions, and that will have an interesting impact in the startup sector. Will open up opportunity, maybe more competition in some of those sectors that right now look pretty locked down by the incumbents.
You also are looking at a continued rise of e-commerce. Does someone come in and disrupt Amazon?
Amazon's pretty well positioned, although Walmart and Amazon are really duking it out. And obviously, they have different strategies, but they're starting to converge. One was physical, the other was digital. Now both are doing more of a bricks and clicks kind of strategy. But that's not the only place to focus. Most of the attention is on what's happening on the direct-to-consumer side of things. There are many companies that have formed, Warby Parker and Framebridge and others also in the last few years, capitalizing on this e-commerce boom. But there's also a lot of great companies that are doing things more on the back end. The consumer doesn't necessarily see it, but companies like BigCommerce or Optoro that focuses on reverse logistics, what's happened when products get returned, or FreightWaves, a company we backed in Chattanooga that's figuring out where trucks should go to deliver the products. So the e-commerce revolution is not just what's happening when you order a product and somebody delivers it to you. It's all the infrastructure that's happening around that, and that will continue to accelerate in the next decade.
Steve, we have just less than a minute, and I really wanted to get your thoughts, given we just surpassed the 20-year anniversary of the AOL-Time Warner merger. Looking back, if you had the chance to redo it, would you?
Well, I would do the deal, but I would execute the deal a little bit differently. Strategically, what we were trying to do, and it was announced just 20 years ago, was to drive the convergence that we've seen over the last 20 years. We've seen things like Netflix and the iPod and iTunes, other things that didn't exist 20 years ago now become significant parts of everyday life. Those two companies, AOL and Time Warner, together had the potential to do that, but they never worked well together. There was a culture clash, a bunch of other challenges. It's great to see companies like Disney really bring the whole company together in a very aggressive, integrated way to launch something like Disney Plus. I wish we had seen some of that 20 years ago when we put AOL and Time Warner together. The quote I've used in the past is Thomas Edison said, "Vision without execution is hallucination." And sadly, that's how I think about that merger. Great promise, but obviously it was a disappointment, a big disappointment.
Well, always great to have your thoughts. So my thank you to Steve Case, Revolution Chairman and CEO and co-founder of AOL. And coming up, patent wars, we'll see how Chinese companies are aggressively pursuing access to global technology. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry On in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Heidi.
Taylor, China's flexible display maker Royal has filed confidentially for a US IPO to raise about $1 billion. That's according to sources. It is now tapping US markets after liquidity tightened during a downturn in China's venture capital sector. Royal is known for manufacturing the world's first commercial foldable phone. The firm competes with Samsung and BOE to produce bendable screens. Credit Suisse has stopped working on the upcoming US IPO of Chinese gay dating app Bloomberg. That's according to sources. The Swiss bank joins other investment firms, including Citigroup and Bank of America, in dropping US debuts of high-profile Chinese companies in recent months. The halt follows growing concerns about a potential sector downturn and the level of investor demand. Amazon has offered Deliveroo a loan after a UK probe into the startup's last funding round threatened a cash crunch. That's according to sources. Without Amazon's backing, Deliveroo could be running low on capital. The size of the loan is unclear, but the London-based food delivery firm is said to have significant funds to continue operating. A spokesman from Deliveroo declined to comment, though. And those are our top global tech stories that we're watching. Sherry.
Heidi, thank you. Now, an achievement in the tech sector for Huawei and China in 2019. The telecom company broke into the top 10 recipients of U.S. patents last year, according to filings with the U.S. Patent and Trademark Office. It's the latest sign that Chinese companies are aggressive in pursuing the U.S. lead in global technology. The ranking helps China overtake Germany for the first time as the fourth biggest recipient of U.S. patents. For more, I'm joined by Bloomberg Intelligence's Anand Srinivasan. Anand, great to have you with us. So it seems that a lot of those patents granted to Huawei were related to 5G, and we have these trade disputes still ongoing, especially in the tech sector with the blacklisting of Huawei, right? How has that affected this rollout?
Look, if you step back and take a look at the broad landscape, it's no surprise that China wants to dramatically expand its tech prowess across the food chain, right? All the way from semiconductor capital equipment to advanced internet services. So it's no surprise that Huawei and other Chinese technology companies across the landscape are filing for more patents to the degree this is home court. So, and it's also a large market, so they want to secure home court advantage, if you may. So to that extent, they are pushing for patent exposure or patent protection in the Chinese market before they expand into other areas. So that's the first part of it. With respect to the global trade drama, look, this is going to be a continuing saga, number one. And number two, we're going to see these patents be enforceable and fought for in multiple jurisdictions, all the way from DC to Europe to China to the US, in multiple jurisdictions, even in the US. So it's unsurprising that this is a natural evolution, both by Chinese technology companies as well as from a location perspective that they're trying to secure this advantage.
Anand, I think more broadly speaking, are you surprised that, frankly, the U.S.-China trade fight hasn't stunted both the short and the long-term goals of some of the global tech companies?
Look, I mean, I am surprised by the fact that it hasn't dramatically impacted. You're right. Right? Huawei is a very large player in the technology landscape, particularly from a domestic Chinese consumption. So its consumption of chips wasn't that substantially affected. Their revenues weren't substantially impeded as a result of the trade drama. So that is surprising. But it also goes to show that the technology food chain and its impact is perhaps far more wide-reaching, deep-reaching than we originally thought.
We continue to see these trade tensions easing, but not happening in the tech front. What happens when you have the bifurcation of tech, when you have 2-3 different internets, different regulations in Asia, the US, Europe? What happens to the future of global tech?
It's not good. Quite simply put, if the escalation had continued to a point where you have this parallel tracks, technology development tracks, then you go back to VHS and Betamax all over again. This time it's regionally split, not company differentiated. And then you run the risk of companies developing multiple chips or multiple sort of standards for one jurisdiction versus another. It's not that far long ago that we had multiple phones that we had to carry that wouldn't work in one region or another. And now the consortium has integrated to the point you have a single device that works globally. Now you ran the risk of potentially bifurcating that again. And I think that risk is now thwarted potentially if the parties come to the table and sign this trade deal, hopefully stage 1, 2, and 3.
Yeah, Anand, when you talk about the signing of that phase 1 trade deal, do any of your outlooks for these global tech companies change given the potential signing that we could see?
I think the implication that the trade deal was going to be signed, or the expectation that the trade deal was going to be signed, was very, very high. Look, semiconductor stocks have rallied 60+% for 2019. Companies like AMD have double that. So the expectations going into particularly 4Q was that we would get a deal signed and that it would not be the worst case scenario. So that was taken care of. Now, from a demand perspective, we still think that 2020 is going to be a pretty good year, albeit second half weighted relative to the first half.
Anand Srinivasan of Bloomberg Intelligence, thank you for joining us. And much more ahead, so stick with us. This is Bloomberg. Time now for a look at the top tech calls. Apple got a rare downgrade by Atlantic Equities Tuesday, saying he has concerns about 5G, services, wearables, and the big recent rally. The analyst said the upside potential from 5G cycle is now more than fully priced in. GameStop shares tumbled Tuesday after it reported a steep decline in same-store sales and lowered guidance for the year. Benchmark analyst Mike Hickey said management has abandoned accountability and sees zero terminal value. He has a $3 price target on the stock. And Tesla shares rose for a second day after an analyst at Jefferies bumped the price target to now $600 a share, saying it would be wrong to exit Tesla on valuation since it is the only car maker engaged in a positive sum game in electric vehicles. Deutsche Bank analysts also increased the price target to $455 a share, saying the company is firing on all cylinders. And speaking of Tesla, Larry Ellison's faith in Tesla and his friend Elon Musk is being rewarded. The Oracle chairman bought a $1 billion stake in the electric vehicle maker before joining Tesla's board in late 2018. That stake is now worth more than $600 million more. Tesla shares have risen 25% in just the first 2 weeks of 2019. Fourth quarter vehicle deliveries beat estimates. To discuss Tesla's recent rise, I want to bring in Joe Osha, energy technology analyst at JMP Securities. So a lot to digest there. I think, interestingly enough, what struck me today, you have a $6,000 price target on the company. You have a $70 price target on the company. Where is Joe Osha's fair valuation for this company amidst all the bulls and the bears?
My fair valuation is below where the stock is now, to be honest. I had downgraded the stock, you may recall, on some concerns about demand earlier. Frankly, I wish I hadn't done it. I would say that the company's competitive position continues to improve, and it's really the only way to play electric vehicles right now. But I'm not sure I want to buy it at the current valuation. You
know, I want to come and take a look at a chart here that I'm showing inside my terminal, because the last time we had you on, Joe, we were talking about this. It is China. And frankly, the bull thesis on this company is that they were able to, frankly, get it done in China. And China makes up, you know, about half now of all total EV sales.
Indeed.
Is China the deal breaker when it comes to the bulls and the bears?
I think it's more than that, to be honest. I was just at the Consumer Electronics Show, which is now the Everything Show. And one of the things that struck me is that other than Tesla and a few of the other EV startups, the competing product offerings are still very weak. So it's a little shocking here at the beginning of 2020 that the major auto OEMs in the US and Europe still don't have a product to compete with Tesla. So China's part of the story, but it's not the whole story.
You mentioned earlier, and I want to come back to it, that you probably wouldn't be buying Tesla at these valuations. It is the rate of change, the rate of movement up that makes you nervous?
Yes, look, as an analyst, whenever you end up in this not very good situation where you've missed a big move in a stock, there's always a temptation to just give in. I don't think that I'm doing my job if I tell people to buy a stock on 20 times EBITDA at this point. So if you're wrong, you try and step back and think about the next thing to do. Tesla's competitive positioning is awesome. That does not mean I'd be buying the stock right now.
So we're going into earnings in a few weeks. You're an analyst. Let's get back down to the fundamentals.
Sure.
What do you want to see from them in terms of numbers, volumes, profitability, cash flow, the works?
Well, they do a very good job of communicating about their business. So we already know the units that they did for the fourth quarter. And I don't think financially we'll see any big surprises. The big question is going to be the outlook for 2020, because it is a new year, and in particular, the margin that they're able to operate at. That's what I'm going to be focused on.
What would you like to see on the margin side to get that profitability, which at one point was so elusive? negative, and
Right.
they've actually been able to show it the past quarter.
That's correct. I mean, I'd certainly like to see a margin, a gross margin in the high teens if I could, and I'd like to see them able to generate, preferably more than $1 billion in free cash flow. I think that's what matters.
Do they have to go back to the debt markets anytime soon? At one point, it looked like they were going to be priced out. How is the health of their balance sheet given the big run-up in the stock?
Well, they are generating cash. They have debt that they will have to refinance. I can't recall if any of it's coming due in 2020, but they have plenty of bankers willing to do it for them on favorable terms. So it will not be difficult for them to access the convertible or the regular debt markets at this point.
Another thing that analysts like yourself are looking at is the Model Y production, which should be kicking off relatively soon. Can they avoid what Elon said was the production hell of starting off that Model 3? Can they avoid that with the Model Y?
I believe so. Look, the Model Y is basically a slightly modified version of the Model 3. It was designed specifically with an intent to make it easier to manufacture on a Model 3 line. So I don't think it's going to be as bumpy, no.
Okay, Joe, one more chart that I'm showing inside my terminal here at GTV Go, buy, holds, and sells. You still have 15 sells on the company. You said that you had just downgraded the company in the recent months. What would it take for you to see to now do an upgrade or a downgrade? What do you need to see from the company to change your opinion?
Certainly. Well, I have said that I believe gross margin is going to come under pressure in the first quarter as the company brings its China facility online. There's also some seasonal weakness that the business should see. So I believe I'm going to get a chance to buy the stock at a lower price. So in the things working out perfectly scenario, that's what I'm hoping for.
Well, talking about working out perfectly, you just came out with another recent report here. It's probably about 200 pages long, so I admit I haven't read through the whole thing. But really, it's talking about your efficiency model. When we mention technology, we think EVs and solar panels, and you seem to say in your report that there's much more going on than that. What do you make of being efficient for companies more broadly?
Well, it means many things. It means industrial processes not generating waste. It means transporting food more efficiently. It means thinking about vehicle electrification other than cars, for example, trucks and buses. It means a more decentralized power grid. So I'm trying to help people think a little more broadly about efficiency.
Well, thank you to Joe Osha of JMP Securities. Always appreciate your time.
Thank you.
And still ahead, Russian hackers show us their favorite playbook in the latest cyber attack. We'll have more on that next. This is Bloomberg. An update to a story earlier this hour regarding Apple and the ability to unlock phones. You may recall that after a December 6th shooting in Florida that killed 3 people, the FBI asked Apple to help unlock the shooter's iPhones. Apple said it was helping, but not before criticism from U.S. Attorney General William Barr. Now it seems the FBI can unlock the terrorist iPhones without Apple. Security experts say the U.S. can crack iPhone 5 and 7 passcodes. Russian hackers are found to have attacked Ukrainian gas firm Burisma as early as November. This is all according to research by security firm Area 1. Burisma is linked to President Trump's impeachment inquiry. Hunter Biden, who's son of the Democratic presidential candidate Joe Biden, was on the company's board from 2014 until last year. The report says the hacking methods were similar as well to the 2016 DNC hack. To discuss, I'm joined by Bloomberg's Karthikeyan Mehrotra. Hugely complicated story. What do we know so far about that hack on that Ukrainian gas company?
We know that it was ongoing as the president's impeachment inquiry was getting really moving in early November. So as the House Intel Committee was considering articles of impeachment, the GRU and Russian hackers were trying to gain access to Burisma Holdings, which, as we know, played a crucial role in this whole inquiry getting started. Exactly what they found when they got in is a question, but we do know that they gained access to employee emails that presumably, if they were able to read through them, could have provided derogatory information about presidential candidate Joe Biden.
They sent out phishing emails, and in your report, you said that they were using similar methods that we saw in 2016 in the DNC hack. Are we surprised that they're still using the same methods?
I think it is a little surprising in that most people thought that there would be an evolution in tactics between 2016 and 2020 in order to undermine the credibility of the election. But what we're finding, and what Oren Falkowitz, whose firm authored the report, said, is that the Russian hackers have been using these tactics throughout the world since 2016, and they're still working. The tactic primarily being phishing campaigns to get unsuspecting employees to provide their credentials and allow hackers to gain access to emails. It's pretty simple, and it's working, so they're still doing it.
If it's still working, then part of the fault perhaps could be on the user then for continuing to fall for those tricks. What do we then need to do to beef up our cybersecurity, as you and I have been talking a lot about in the last few weeks?
I think it's fundamental when it comes to phishing. It's knowing how to identify a phishing email, to know that this is not a credible sender. Don't click on this link and put in all of your personal information. Things that to us may be obvious, perhaps when you're sorting through emails and you don't want to get caught off guard, you end up offering your information. And then there are companies like Area 1 that are providing services to filter through those emails to identify which ones may be phishing campaigns to save you from having to make that decision yourself.
What did this hacking tell us about tactics in 2020?
Well, the notion that the same campaigns are being used offers some intel into what to expect in 2020. If we're not getting into the hypotheticals of hacking into industrial control systems, but actually thinking about the ways in which the U.S. was attacked in 2016, we can expect more phishing campaigns that attacked the DNC, the Clinton campaign in 2016, to be used against voter registration databases and state election officials in 2020 as we gear up for the election. Couple that with disinformation, which we saw plenty of in 2016 and since. That's a formula that could be ripe for at least attacking the credibility of results, if not actually changing results.
Right. Well, thank you. That was Bloomberg's Kartikeya Mehrotra. Thank you for joining us. And we are getting some headlines here from Nancy Pelosi, Speaker. She's going to announce impeachment managers Wednesday at 10 a.m. This is, of course, as we continue to follow the impeachment process and the vote. So Pelosi announcing impeachment managers Wednesday at 10 a.m. We will keep you posted as we get more details. Now, Bloomberg has also learned that Google is planning to end the use of cookies as a tracking tool on the web. Over the next 2 years, Google plans to phase out third-party cookies in its Chrome browser. The little bits of code are currently used to follow people around the web and are a core part of the online advertising landscape. Both Apple and Mozilla already block such cookies. So to discuss, our own Mark Bergen, who covers Alphabet. So Mark, increases users' privacy. Is that the goal?
That's the stated goal. You know, this movement, the ball's been rolling here from Apple with the Safari browser, and then we saw Mozilla. The pressure was on Google, which basically has the rest of the market share for web browsers, to make a similar decision. For a long time, Google was sort of suggesting they were not going to go in this direction. Like, obviously, Google's a bulk of their business is dependent on advertising, on digital advertising. A lot of it's dependent on this sort of ecosystem of what you call third-party cookies, where, you know, there's the ad tech world that tracks user behavior. They're actually taking a strict line in the sand here. The repercussions we're already seeing. Criteo, which is an ad tech company, fell about 16% within the market today. So it's already going to have ripple effects, and I'm sure those are just going to continue over the next couple of years.
Yeah, how are advertising responding to this?
I think that thus far the market response, and certainly from people in the industry, is they're a little bit surprised. Like, they see it coming, though. The writing on the wall from both the privacy laws in Europe and then in California. I think there are people that will certainly privately say this is a chance for Google to, either intentionally or not, just continue to dominate the market, right? You know, they're pushing some of these middlemen and rivals out. Google has the resources, whether it's legal or first-party data in this case, where a lot of people are using Google services, and therefore Google's sort of advertising business and its market cap is probably going to be not as effective as others.
You know, it's curious, the timing of this, given that in your reporting you said that Apple's Safari and Mozilla's Firefox have already gotten away from not using those cookies. So why does Google do this now when competitors, frankly, are ahead of them in this?
I think part of it will be the California privacy rules and that what's coming forward. And Google, unlike Apple and certainly like Mozilla, they have a lot of partners. They have a lot of partners in the publishing industry, on the marketing side, in the ad tech world. A lot of stakeholders at play, and so that could be part of it, where they're doing their best to keep a lot of these stakeholders happy, right? Certainly their marketing clients that provide them with billions of dollars every quarter, and then the publishers, if they have an en masse sort of movement away from Google. I mean, at this point, Google's so well entrenched into every single marketing spend and an agency, like they're looking at dollars, they're going to spend a bulk of it on Google. But that was probably the reason why they took so long to make this decision.
Well, Mark, as we talk about Google and advertising, we'd be remiss if I didn't come and show you a chart that I'm showing here inside my terminal, which is Google approaching that key $1 trillion value mark today, closing at about $987 billion. What are you hearing about the continued optimism around this company and their advertising business that's getting us to $1 trillion?
So a couple things, and the analysts in the street are looking for in 2020. They're excited about there's a new hire bill ready from PayPal coming with a run of commerce at Google. And e-commerce and shopping in general is something that Google's kind of struggled with next to Amazon. So there's a hope here that commerce will kind of click in for 2020 and can really unlock a lot of potential. The second area is with Google Cloud's business. 2020 is the year where the company really has to demonstrate that it is catching up to Amazon and Microsoft and really showing some big wins. There are a lot of expectations that they may actually, for the first time ever, disclose revenue and break down those financials, and that would, depending on the results, have a big impact on the stock.
Thank you to Bloomberg's Mark Bergen. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.